Solar ITC is the standard name, is what you're going to hear. A tax credit is a dollar for dollar reduction in income taxes that a person or company would otherwise pay to the federal government. The ITC is based on the amount of the investment in solar property. Both the residential and the commercial ITC are 26% of the basis that the invested in eligible solar property. The ITC then steps down according to the following schedule, and I'll show you that here in a second. So here's the main thing. If the homeowner buys a newly built home with solar and owns the system outright, the homeowner is eligible for the ITC the year they move into the house. If the homeowner leaves the solar system or purchases electricity from the system through a power purchase agreement, PPA, or a lease agreement, then the ITC is claimed by the company that leases the system or offers the PPA. So the big difference between purchasing and leasing is the company who's leasing you the equipment owns the system. The person who's buying the equipment owns the system. So you have what's called a power purchase agreement with the lease. They're going to go ahead and put the panels on your roof and not charge you for the equipment because they own it. You're going to be paying them like a utility company for the power it produces. The problem is with leases is that they usually increase between 1.9 and 3.9% every single year. They're not common anymore. Okay, Sunrun typically will still do them. They are a leasing organization. They do have purchases nowadays, but they're not common. You're not really going to be seeing a lot of them. But that's the main thing that you need to understand when you're looking at those. The company owns it. So yeah, I want to get my ITC. Great. Then you need to buy the system. You need to own the system because you'll be the one that's going to be eligible for it. The federal tax step down is as follows. Okay. In 2022, this year, it's the last year for 26%. The federal government will take care of 20%, 26% based off the federal ITC, and then the homeowner will take care of the remaining 74%. Now, either way, it still works just like that. With the ITC, it's based off of the tax liability. So if they owe, they're not going to get it. They have up to 6 years to claim the full amount that they qualified for when they bought their system. It is also dependent on when the system is installed. That's going to be another big factor we're going to talk about in a moment. In 2023, it steps down to 22%. So that means that if they qualify for the full amount, the government's taking care of that. Whether they reinvest it back into the system through financing or they pay themselves back because they paid cash, the government still gave them 22%. They really only came out with 78% of it. Okay, so that's one way to look at it as well. In 2024, it is gone completely. There might become a point where they bring it back. We don't know. We're just going to go ahead and project that it's not going to happen. So the commercial side of it still will have a 10% ITC for commercial projects, but only 23 in 2023. After 2023 and 2024, it's 100% on the homeowner. So things you can and cannot say about the ITC. First, we're going to go over what you cannot say. You cannot review their taxes. Under any circumstance, you are not allowed to review the customer's taxes. There's a couple reasons why. First of all, you are not a licensed CPA. We are not a tax firm, so we don't have the proper licenses to allow you to do that. Even if you do have the proper licenses yourself, you're representing Solar Panel Pro. You are not representing whatever firm that you or brokerage that you have that would allow them to review their taxes. You cannot review their taxes to tell them if they would qualify or not. You cannot review their income to see if they do it. Okay? These are both very important because on their tax document, there are social security numbers for the entire family. You do not have the appropriate clearance or certifications or licenses to be looking at all these people's social security information. Do not do it. It is illegal. You cannot promise them or guarantee them that they'll get a payback on it. It is, I'm not going to say why. You guys see over here. And then you can't consult them on what to do with their investment. You can tell them, like, this is what would happen if you reinvested it, your payment would stay this. And if you kept it to do these, you can give examples. This is what your payment would go to, but you can't tell them you should or you will be doing this. That is not your job. It is their tax credit. They can do whatever they want with it. If they have tax debt, they can pay off tax debt with that. If they want to pay off a credit card, they can do that. If they want to remodel the house, they can do that. If they want to, pay down a car, they want to go on vacation, that is their money. They can do whatever they want with it. You cannot call it a rebate or a deduction. A tax credit and a rebate and a deduction are three very different things. And you can't tell them that the date of the sale qualifies them for the amount. Things that you can say. You can refer them to the form 5695. That is the federal tax form to be able to claim the ITC. If their CPA isn't aware of this form, then you can actually refer, you can tell them, hey, there are other CPAs. You can find somebody else who does. If you know a CPA, you guys can refer them over, but you still can't review their taxes. Nothing else. You can tell them the name of the form. The company will send them an example of what the form looks like at the beginning of the year. So if they do their own taxes, or if they want to give the sample of the form to the CPA or their tax person, they can do that. You can refer them to talk to a CPA or a tax specialist. You cannot do it for them. You can't talk to the CPA or tax specialist on their behalf either. You can explain the reamortization and the ream period. Okay, so that is an 18-month period to where the finance company understands that they can't file their taxes tomorrow for this year because their system is not installed yet. So they're going to give them 18 months to reinvest the amount. That's important, to reinvest the amount of the tax credit to keep that number, that payment the same, and decrease it. That's really, 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 really important that you understand that. It is the amount, because if they only qualify for half of it, if they want to keep that payment, they're going to have to come up with the other half to put as a down payment. If they spend half of it, their payment is going to go up. So it is the amount. They could do whatever they want with it. But if they want to see that number, that low number, and maintain that from payment 19 forward, they're going to have to reinvest that amount that we're showing on the paper. It is an investment tax credit, and it's based off of solar. And the install date dictates the qualifying amount. So if they are installed on December 31st, 2022, they will qualify for 26%. If they are installed on January 1st, 2023, they get the step down and they now only qualify for the 22%. That is very, very, very important.
Sale date, install date.
Dictates qualifying amount. Install date dictates.
Install date.
Oh,
I'll leave this up for a second for you guys to write this stuff down. This entire slide deck, just like the other one, will be available on the website. Now, where can they get the form themselves? They can get it from the irs.gov. It's right there. You can click in the search box, you type in 5695 and it will pop up. Residential energy tax credit. It's exactly what it looks like on the screen right there. It is the federal 5695. That's my dyslexia. For being dyslexic, I have very few typos nowadays, thanks to Brian. Now, this is what you need to know about the amortization. The reamortization loans are one of the most popular types of solar loans. In solar reamortization loans, you can get one free reamortization period in which you can buy down the principal of the loan amount and lower your monthly payment. This is designed to allow you to claim the federal tax credit, ITC, during the tax season, 26% of your total system costs at the time of this writing, and put that money back into your loan. It's dictated off of install date. You would start at a certain monthly payment, which reflects 100% of your total system cost. Then when the tax season rolls around the next year, you could claim the ITC, put the money back into your loan, and have a new lower monthly payment that reflects only 74% of your total system cost. Additionally, you can put out-of-pocket money or out-of-state incentives in when you reamortize, dropping your principal and monthly payments. Now, the nice part about the Good Leap, whether you're doing just a traditional loan or you're doing the flex pay. The flex pay is essentially an interest only for 18 months, lowering it even more. The traditional loans with the Good Leap program are an 18-month that allows them to pay the same amount that they would pay if they've already reinvested. So they're going to assume that you've done that and give you a break for your first 18 months. What this bottom portion means is that anything you pay over the principal during those 18 months goes down towards the principal and as a down payment. So if they come up with an additional $10,000 on top of the ITC and the state incentives that they qualified for, on average about $5 for every $1,000 they invest, that's an extra $50 a month off their payment. Another important thing to know about these loans is there is no prepayment penalty. If you've never heard that term, what it means is if you pay off your loan early, you are not penalized and have to pay a portion of the unpaid interest. You only pay interest up until the day of that payment, the final payment. That's so important, and a lot of people love that. Because if they're like, I want to pay this off in 5 years, I don't want to do a 20-year loan. Here's the nice part. You could do the 20-year loan and still pay it off in 5. That way, if an emergency comes up and you only have enough to pay the minimum payment, which is the one that you like here, you can still take care of that and then continue paying back what you want to pay it off early and still only pay the same interest up until the day that you needed it. Huge selling point. So the entire recap of this is very simple. They're going to assume that you've already put it down and they're going to give you the small payment. If you reinvest, it stays the same. If you put anything more on top of it, your payment will go down because anything made over that payment goes directly towards principal and down payment during your reamortization 18-month period. After that, it just goes towards principal. And you can pay your system off with no prepayment penalties. For the majority of our customers, this new reamortization loan payment is significantly lower than the price of electricity from the grid. Not only that, but after reamortizing, your payments are fixed for the entire term of the loan. This means that the electricity rates keep going up and they're rising exponentially year over year. Your payment stays low and fixed. It is also important to note that you don't have to put the entire ITC back into your loan. You can keep the 26% tax credit for yourself or reamortize with whatever fraction of it you see fit. It's your money. Decide what you want to do with it. That is what you have to say here. You don't have to put it back in. That's your call. But if you don't, this is what it would be. And you could just uncheck the box and it'll show the payment. That's how beautiful it is on that proposal. So amortization. In solar reamortization loans, you get one free reamortization period in which you can buy down the principal amount and lower your monthly payment, right? So that's just a repeat. Typical reamortization periods are 18-month periods before they take effect. This is the finance company taking consideration of the homeowner reinvesting the tax credit as a down payment. Give you guys a couple seconds to write whatever you feel is important about that sentence down. Just to recap again, it's not a tax deduction. It is not a tax, it's not a deduction, and it's not a rebate. It's a tax credit. Qualifying solar systems are simple. The homeowner may ask you if they qualify for the tax credit. You cannot tell them if they do. You may offer information regarding a qualifying system, but not their finances. This is no income cap on the ITC. There is no income cap on the ITC program. None. Your PV solar system must be installed before January 1st, 2006 by December 31st, 2023. Okay? Those are the big ones. That is the only period of time in which you can get the solar tax credit right now. After 2023, there is no more ITC. The solar PV system is new or being used for the first time. The credit can only be claimed on the original installation of the solar equipment. You own the solar PV system. If you purchased it with cash or through financing, but you are neither leasing nor are you in an agreement to purchase electricity generated by your system, you do not own. So leases and PPAs do not qualify for the ITC for that homeowner. The owner of the system gets it, which is the leasing company. The solar PV system is located at your primary or secondary residence in the United States, or for an offsite community solar project. If the electricity generated is credited against or does not exceed your home's electricity consumption, the IRS has permitted a taxpayer to claim a Section 25D tax credit for purchase of a portion of a community solar project. Federal and state tax credits are separate and require separate tax forms. So each state has different ones, and they will be provided to you for your state. State tax credit. State tax credits for installing solar PV generally do not reduce federal tax credits, and vice versa. However, when you receive a state tax credit, the taxable income you report on your federal taxes will be higher than it otherwise would have been because you now owe less state income tax to deduct. The Tax Cuts and Jobs Act of 2017 placed a $10,000 limit on the state and local tax deductions, which may impact whether a state tax credit impacts federal taxable income. The end result of claiming a state tax credit is that the amount of the state tax credit is effectively taxed at the federal tax level. The big thing to take out of this is that they don't affect each other. So if you get $1,000 from your state, it doesn't affect your federal. And if you get nothing from your state, it doesn't affect your federal. There are some states that don't offer tax credits whatsoever. Utility rebates. Under most circumstances, subsidies provided by your utility company to you to install a solar PV system are excluded from income taxes throughout the exemption of federal law. When this is the case, the utility rebate for installing solar is subtracted from your system cost before you calculate the tax credit. For example, if your solar PV system was installed before December 31st, 2022, at a cost of $18,000, your utility gave you a one-time rebate of $1,000 for installing the system. Your tax credit would be calculated as follows. 26% times 18,000 minus 1,000 would be 4,420. So really simple. What this means is if you get a rebate from the utility company, you may have to deduct that from the price before you can calculate it. This is done typically through the proposal process. So you just explain that they would get a rebate from the utility company. It's usually a separate form they have to do with their utility company.